when it boils down to it, most people putting money into a pension haven't got a clue where a lot of it's going anywhere. I think they need to pay closer attention to where their money is going and where it's being invested. They may not like it where a lot of it's going anyway, especially those with sort of ESG concerns and ethical concerns. They may not like it at all where their hard-earned salaries are, what they're funding, what they're supporting.
Hello and welcome to the Fundamental Asset Podcast with Fund Manager Chris Boxall. Today's episode is the start of a new podcast series discussing where your pension money is going. We start off with the recent proposals by Jeremy Hunt at the Mansion House speech. Should pension savers and private investors be concerned about this proposal to direct billions of pension savers' money towards UK small caps and unlisted companies? What will it mean for pension savers and private investors? Will these proposed billions lead to a stock market bubble and the inevitable crash thereafter? Or will it lead to a whole host of yet new to be formed companies that pension savers, private investors and UK PLC will benefit from? Let's get started. Hello Chris, how are you today?
I'm very well, Lee, and you? Hope you're well.
Absolutely brilliant, really good. As the intro said, we're going to look at the Mansion House speech and we're going to try and dissect where people's money's going. But before we get into that, I thought it'd be good to share a little bit of news and a little bit of what's been going on in the stock market, particularly around the AIM in the last month or so.
The UK stock market has still been very challenging. And, the takeover activity unfortunately continues. I say unfortunately because some investors may say whoopee-doo when their stocks shoot up in value on the back of a takeover approach. But we feel that a lot of these takeovers are pretty lowball offers, and we wonder why people are accepting them. The latest news on takeovers from our universe is a company called Smart Metering Systems has received an offer that values the business at about 1.3 billion from one of the largest UK private equity firms called KKR. Clearly, management's behind this in support of it. And so AIM is likely to lose a very nice company and one of its biggest dividend payers, if not its biggest dividend payer. So that's going to be a real shame. So shareholders are probably looking now, right, we're going to take a quick 40% premium. Or the alternative is we sit this out, support this business, discuss what it needs to grow, prepare to be a little bit patient, and maybe 3 years down the line, it might have doubled. So it's doubling your money in 3 years, plus receiving some dividends or taking the money now. But we find it all very disappointing, all these takeovers of AIM companies and other smaller quoted companies on the UK stock market.
Has there been any new companies come to the market of late?
Ironically, there has been just one new company. One new company in the last this is in the third month. So October and November didn't see any newcomers to AIM. And there were, I think, 18 companies left AIM. So 18 leavers and no newcomers. And December has seen a small business called Chapel, which is a winemaker, a very good winemaker apparently, move from the Aquis Exchange to AIM. And it's about 80 odd million market cap in size. I don't think he raised any more money. It's got a nice business. It's a Kent-based winemaker. Apparently, it's sparkling wine. It's really good. I remember having a bottle a long time ago. It's not that cheap, but better value, I would say, than champagne. And could this be a sign of the future? The UK will soon become a market of wine companies. We got two on AIM now. Gusbourne's the other one. Chapel has joined it now. Who knows? In 100 years, the UK will challenge champagne as the de facto place for sparkling wine.
Who knows? So it'd be interesting to get your take on the Mansion House speech because, as the intro said, the Chancellor intends to direct 5% of pension funds into unlisted companies, high growth unlisted companies. What I want to break down is what does that mean economically, morally? And I also want to let the audience know what is an unlisted company, what is high growth companies, and really just have a good discussion with you around the implications of this because it's quite bold. It could have big impacts, but it could have negative impacts. And I think it's only fair that we try and share with the audience what those implications are.
So I think it's very bold. And I would say it's somewhat foolhardy. Let's go on to that. First of all, unlisted companies, as the term suggests, is a company that's not listed on the stock market. So a lot of private companies, and unlisted in that instance actually seemingly includes AIM companies because they're not strictly listed. AIM is a regulated market, but it's not been to be a listing, a formal listing. So AIM companies could be included. So everybody's thinking, wow, this is great news for AIM. There could be a flood of money coming in, and it could be good news for smaller private companies. I haven't got a clue how one defines high growth. I mean, in terms of high growth in the UK at the moment, it's anything growing at all. I think if you look in the United States, I think high growth's a whole different ballgame because companies there, many of them are growing very fast, even some very big ones. So how does one define high growth? I do think it's dangerous. I'm speaking as a manager and investor in AIM companies as a potential beneficiary of this large S. But we've seen this before. The UK has a lot of incentives, tax incentives already to invest in smaller, earlier stage companies. We have at the lowest level the seed EIS scheme. Then we have the EIS scheme. Then we have venture capital trusts. And in terms of AIM as well, AIM companies can also benefit from business relief. So if UK holders retain the shares for 2 years and hold them at death, they will avoid inheritance tax on the value of those holdings. So there are a lot of really attractive tax breaks already. From my perspective, the fear from adding a whole heap of money into the market is the risk of creating a classic bubble scenario. It's just going to be too much money chasing too fewer opportunities. And I think it could be really dangerous. And I think we also, don't we, have to really consider what the beneficiaries of this pension money may be thinking of that as well.
When Jeremy Hunt says unlisted companies and high growth companies, there'll be a lot of the audience or potential audience that's listening to this, and they won't even know what an unlisted company is. And I know you touched on it and you said that could include AIM, but could you just expand on what an unlisted company is and what will their pension money be investing in?
As I suggested, it could be any business not listed on a stock market. It could include a host of small companies. Some of them are very early stage. I mean, there needs to be more detail given for this, but some of them could be very early stage. Some of them could conceivably tie in with private equity backed companies. In private equity, as the name implies, funds companies in the private sector. So again, not listed businesses that aren't listed on a stock market, a formal stock market. So you don't get that much transparency or visibility from private companies in terms of reporting. If a company's listed, there are a lot of demands to provide accurate reporting and accounts. And there's an awful lot more due diligence that needs to go into things when you're investing in a business that isn't on a stock market, which has looser corporate governance, looser reporting. There's no formal requirement to submit interim results or produce regular updates. So it's very different. And I think we saw a risk of this whole scenario over in the era of cheap money. When interest rates were low, you had private equity and flooding the market and buying up everything, leverage things up with debt to achieve sort of artificially inflated returns. If you flood a market with too much money, it will elevate prices to artificial levels, and it could conceivably be funding the wrong sorts of businesses. It's very dangerous, and it would need. Seems to me there's be so much detail needed to really ensure that it works properly. Just think it's a really tough thing to contemplate.
You mentioned there as well, we need more clarity on what they deem an unlisted company is, because as you said, that could include AIM. But you did mention there that private companies that predominantly are funded by private equity, what they have to report is not quite as stringent as a listed company. That could prove a bit of an area of concern, would you think?
Yeah, look, our experience with investing in off market is always been strained. And we appreciate early stage businesses come with risk and you're getting a big tax break. That's fine. It's often the reporting that's really annoying. Once you're starting to attract money from the public in general, you should impose firm reporting requirements and timely reporting. The number of companies we come across raising money on the EIS, and you have to wait months and months past the due date to receive any information. It's really, really poor. And the more money that floods into this, the more the demands will be on this kind of more timely reporting. I just think it's a recipe for disaster. And it's again, contrary to the current scenario where there are an awful lot of tax breaks already on offer. A lot of tax based money is already supporting numerous questionable businesses, some of which have really flawed business models. You really wonder how they ever raised money in the first place, especially at the stratospheric valuations that a lot of them are demanding. The number of businesses that we see that whip up a PowerPoint presentation and a decent idea on some, I don't know, concept that they think might work and label it with a multi-million pound valuation before they've even got out the door. I don't get it. But they do get funding. I mean, it looks crazy, but they do pick up funding.
If Jeremy Hunt's plans go ahead, there's going to be an extra potential 50 billion worth of funding of UK retirement savers pensions going into this area. So this is why it's really interesting to have this conversation with you, because you are in this area, don't you? You are in this space. This is
It'll
your
be great for our
experience.
business. Yeah,
Exactly.
great.
Yeah.
Wow.
It'd be great. And you have concerns about it. So this is why we're trying to dissect this. So you mentioned private equity there. It sounds like they're going to probably benefit from this private equity.
Yeah, I don't know. Clearly, they've had enough. Again, it depends on the structure of the whole arrangement. But private equity's business model, as I said, is one generally of loading up their acquired companies or acquiring companies effectively with an awful lot of debt. And the debt's been very cheap until recently.
Mm.
Now it's a little bit more expensive or a lot costlier. The business models of some of these private equity driven deals are flawed, in my estimation. And you're even seeing that on AIM. We're seeing businesses that adopt a so-called buy and build strategy. I can't stand the term, but there you go, a buy and build strategy
Mm.
with little to no. They've never worried about organic growth. They've simply acquired companies largely with debt. And they're really unraveling at the moment. The debt's
Right.
gone up. The finance charge has gone through the roof. The businesses they bought, they're not generating any organic growth. Often they bought at the peak of the market as well. So you can see it's a business model that needs a certain level or certain, the nature be to be a certain type, i.e. very cheap money.
Do you think 50 billion extra coming in could carry on more cheap money?
The total value of AIM at the moment is under 80 billion. That's every single company on AIM. So if you start chucking a bit of those billions just at AIM
Wow.
companies, you can see that we're all going to be chasing the same sort of dream. More positively for the stock market, it might encourage more companies to join. Although some of them, if they're private already, they don't have to join the market. Under this plan, the private company is going to be the beneficiary. So they may not need to join in. There's going to be a pool of money available to them from not necessarily being on the stock market.
So that's an interesting point there. Let's hypothetically say that this pension money comes in and they do really well, but they're actually going to be private, aren't they? So the average sort of investor with a stock market trading account, they wouldn't be able to access these private companies. Is that right?
They might do secondhand via a private equity fund as well. So there might be private company A might receive funding from the pension funds effectively putting money into it, but the structure is run by a private equity manager,
Mm.
which in turn may operate under a vehicle that's listed on the stock market. Or it might be a private vehicle that outside third party investors want to, come into as well. There are going to be opportunities. But when it boils down to it, most people putting money into a pension haven't got a clue where a lot of it's going anywhere.
Yeah.
Anyway, I think they need to pay closer attention to where their money is going and where it's being invested. They may not like it where a lot of it's going anyway, especially those with sort of ESG concerns and ethical concerns. They may not like it at all where their hard earned salaries are, what they're funding, what they're supporting.
Yeah, well, I agree. And that's why we decided to start this podcast series, because the way Jeremy Hunt framed it was unlisted high growth companies. Has there been many high growth unlisted companies that private equity has brought to the market that the investors can be confident that's where their pension money is going?
Over recent years, there haven't been very many successful high growth private equity exits onto the stock market. There have been a lot of very bad ones, especially in 2021. I mean, AIM had its fair share of flawed business models that decided to join the market in 2021, a lot from the online retail arena that were found to be real bubble stocks. They benefited over the pandemic, but thereafter it's been a struggle. There's been a history of a lot of private equity backed offerings. I call them private equity dumps on the market because the private equity has exited at some inflated price, only for the company in question to be nothing like they projected to have been. So it has been a real problem, and we've seen lots of them. So I personally don't have a warm feeling about many private equity related deals, at least not the ones that I've come across. A few years back, it was a different market. Pre the area of low base interest rates, there were some interesting issues on particularly on AIM, and some of those businesses have gone on to really great things, become substantial companies. But over the last few years, it's been a lot more of a struggle to find decent private equity-backed companies on the stock
Yeah.
market.
Would you say at the moment we're seeing more companies going private than we are seeing coming to the market over the last 2 years?
Almost, yeah, most
Would
definitely,
there's been
most
a shift,
definitely.
hasn't there?
Yeah, we've had barely any new issues, barely any IPOs. We've had loads of takeover by private equity groups, many of them US based, who are still awash with cash and want to deploy it. So a lot of good companies, good AIM companies, good cash generative companies that could go on to do to great things on the stock market are being snapped up and off they go. And it's rare to see things being taken at a really attractive premium. Hotel Chocolat was bought for a really big premium to the share price at the time. However, it's still a price well below its previous highs. And Hotel Chocolat was acquired by Mars, which
Mm.
is a privately controlled company, but the Mars family is still behind it. And they're very patient. And Hotel Chocolat needed a big parent to really help its international growth. It had really struggled. It had fallen
Mm.
down numerous times trying to grow in the US, in Japan. It had some real problems. So I think it's a good thing for Hotel Chocolat. But that wasn't a private equity deal. That was an industry buyer who put forward a lot of money, a big premium, and is clearly willing to be patient. But a lot of the others have been private equity funded deals. When you flood a system with too much money, it's asking for problems indiscriminately.
Mm.
You could say this scattergun approach, I don't know what the chances think it may deliver the odd fantastic business. So, you're going to have a whole pile of rubbish that gets lost by the wayside. Its aim is to support and get behind some
A
real market
unicorn.
leaders. Exactly. But sadly, the UK has been a bit short of unicorns. One of the last great companies, the ARM,
I was going to
technology
say
wise,
yeah.
is on the US market. Another great, amazing UK business called DeepMind was bought by Google a few years ago and is now the key engine behind Google's AI. That's an unbelievable technology. So we lost those two. Can't see where the next one's coming from. The UK has become a market, sadly, of sort of niche technology offerings, not real dominant market leading
Yeah.
ones. Well, there are a few exceptions. There are obviously some really nice businesses, but there are a few that are going to take over the world, in my opinion.
Shall I share a quote with somebody who shares your same opinions? John Graham, President and Chief Executive of the Canada Pension Plan. He has assets, or he oversees assets of £337 billion. And this is his quote: UK retirement plans should not be told where to invest their money. He is opposed to any constraint on portfolio construction or any influence in a specific asset class or specific part of the market. So that's the CEO of the Canadian Pension Board, and he is opposed to this idea.
I'm with him, and the Canadians
Yeah.
have proven to be quite prudent
Mm.
managers over the years, and so would tend to agree with that. And I
Yeah.
think the devil is going to be in the detail of this Mansion House speech, and we wait and see. Saying that, the UK stock market does need to liven itself up, and it certainly needs to do a better job of communicating its appeal. But that's for it to do, not to be artificially boosted by a heap of cheap money coming in again. Free money, do I say?
Yeah, free money that's actually the retirement savers of this country as well. It's not even like they're using tax incentives or tax breaks. This is actually people's money.
Yeah, and the pension money managers surely have a fiduciary responsibility to invest what they think is best for their beneficiaries, their pensioners. And that has driven a lot of them to look elsewhere for returns. The percentage of pension money in UK stocks is, I think, at an all-time low. And that's just market forces. They're seeing better returns elsewhere. Well, they got to go elsewhere. You can't, I feel,
Mhm.
dictate to people where they can get the best return.
Again, John Graham completely seconds that. John Graham, because he says if you want more private investment, you need stability. We like to see governments around the world creating a stable regulatory and tax regime that facilitates long term investment. You've already pointed out there's a lot of tax breaks here in the UK for small companies. But one thing that we have had since Brexit of 2016 is we've had 5 different prime ministers. I don't know, do you think that creates stability?
Yeah, it could be better, couldn't it? It
It
could be
could,
better.
couldn't it?
And we've had some interesting characters as prime ministers
We
as well.
have, yes.
So it could be better. So yes, we need stability. The tax breaks are there. We need to get behind the existing breaks. Perhaps they need to be fine-tuned a bit. We need to perhaps offer greater tax incentives for real growth companies, whereas a lot of them are bracketed in the same sort of area. So you can have the EIS applies to a whole growth gamut of startups. Perhaps certain categories of startups in technology or certain areas where there needs to be greater in the sciences need to be given an extra tax boost of some kind, which is surely possible.
Yeah, I would have thought some sort of tier to tax break for new companies would have been a much better way to go ahead than taking the pensions of private individuals. But the US last year started on their own trajectory to stimulate the economy with the Inflation Reduction Act. And they went down that road. They went down the tax breaks, allocating approximately about $30 billion for the Chip and Science Act. So, according to the Congressional Budget Office, the Joint Committee on Taxation, the law will raise approximately $738 billion from tax reform, as well as an authorised $891 billion in spending on energy, climate change, and science and manufacturing. So, while the UK is taking the money from people's pensions and directing it to early startup companies, the US has decided to go much more around the tax incentivization route. Who do you think is right?
First of all, the US, they're chucking a lot of money at it, that's for
Yeah.
sure, as they can do. The US system, generally speaking, has worked quite well over the years. Businesses it's developed, they have a much bigger economy, which
Yeah.
means you can get things going and get up to speed quicker or discover if you're going to fail sooner than you can if you're in the UK and you can't get around. There are certain
Mm.
businesses that you can really scale up simply based on your home economy. It's fabulous. But their attitude to risk is different as well.
Mm.
Failure isn't a disaster and over there and it can be over here. Our cultures are just ideologies very different. I think they're better suited to be entrepreneurs and they're also great salespeople, which helps because that's half the task initially to sell your idea, communicate it effectively to investors and to all stakeholders to drive things forward. Going back to a thing to help drive the UK stock market, I think there needs to be a lot better communication. That's been a real failing. But
Mm.
yeah, you'd never bet against the US, shall we say?
I think we're both on the side of we don't think this is a particularly great idea. Not that we have any control over it, but I think people should be much more aware of where that money's going and what it's investing in. And the track record hasn't been fantastic. And we're all of a sudden going to be bringing more money into a very small niche market that might look good on paper, but over time could end up resulting in a bubble.
Yeah, I think is it another case of government chucking out an idea, wanting us to beat it up and have a think about it, and then perhaps backtrack on things, or with the outcome being very different in the end, the final outcome being very different to what was originally proposed. At the moment, we've just got the headlines and the highlights, but by the time it's finished, we'll see something very different in the detail.
That's a fair comment, actually, because they have literally chucked the headlines out, haven't they?
Absolutely.
Anything else to add, Chris?
No, other than the fact that it's great to see Chapel Down join the UK stock market. Well done, Chapel Down, for joining, and we wish it great success.
Well, that's it for today. If you enjoyed this type of content, then please subscribe and leave us a comment to let us know. If you want to learn more about Chris and fundamental asset management, all the links are just below in the show notes. Thanks for listening, and I hope you have a great week ahead.